Hi, everyone. This is Jason Bierk of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a first-time guest. I've actually gotten a lot of listener requests to have him on. He is a true oil and natural gas expert. I've been looking at his interviews. He's actually produced amazing oil and natural gas returns on some of these small cap Canadian oil and natural gas companies. He is the CEO and founder of White Tundra Resources and White Tundra Investments. I think he has a publicly traded oil and natural gas company soon coming to to the Canadian stock markets. Shubham Garg, thank you for joining me.
Yeah, thanks for having me, Jason. Good to be here.
So we're recording this interview on Wednesday, March 13th, 2024. West Texas Intermediate prices are at $78.23. The U.S. natural gas price is at an extreme low. It's at $1.70. It's at a crazy low price right now. Before we talk about natural gas prices, I want to ask you about oil supply demand fundamentals. We had another oil expert. This guy's name is Paul Sankey. He's claiming that the Saudis are subsidizing oil prices to keep them up. Do you think that that's the case, or do you think that all of OPEC needs an oil price at current levels or substantially higher just to balance their government budgets?
Yeah, I think this has been one of the major points of discussion over the last couple of years is there's OPEC, which is been suffering in some regards over the last kind of 10 years, let's say. You take 2014 to 2020, the average oil price during those years was $50 WTI. So not only are we looking to balance the budget today, but there's a period that's been quote unquote the lost years for those countries where they pumped away trying to kill U.S. shale, and they just were not successful at that, other than a brief period in 2016. So really, they're having to make up for that. They've got very, very young populations that are looking to grow the economy. They're looking for jobs. They're looking for more infrastructure development, and you have the budgets that are just going up. So I think a large part of why they're out reducing their supply to the market is the fact that they need higher prices to go and balance their budgets and to provide for their people and grow their economy. But also, there's sort of a secondary reasoning for this is when you have a global oil market and you have investments that are being put in year after year to go and grow the supply, the impact of that is not right away. There's a 1 year gap, there's a 2 year gap. In the case of deep water offshore, there's a 3 to 4 year gap. In the case of the Canadian oil sands, which is becoming a more and more bigger portion of supply, there's a 5, 6, 7 year gap between when you decide to invest and between when that oil comes online. So during that time frame, we need oil investments so that as we get into the further years, that supply is there to meet the growing demand. And so OPEC and OPEC Plus realizes this, that if there's not investment today, you're not going to see that barrel, and you're going to get immense volatility in the price of oil, even further than what we've already seen over the last 2 or 3 years. So they're sort of bringing the price up at a point where it enhances the investment and allows people to put money into the market, knowing that going down the road there is going to be that return that they're looking for. And this is something that I think is maybe something that's behind the scenes slipped, because a lot of money went into oil sands, a lot of money went into deep water offshore, assuming a higher oil price in 2010, 2011, 2012. And well, bam, once those projects came online 5 years later, the oil price was $40 or $45, and all that money was essentially either wiped out, or it took so long to make that dollar back that investors are just not willing to go and put that dollar back anymore. So dual-minded effort there by OPEC, both to help their internal economies, but also to go and stabilize the oil markets at a future point in time. And I think the latter part of that is maybe less respected, because it does require a slightly higher price today in order to bring the market in a more stable and less volatile environment as the years go on.
I think there's also been a lot of higher input costs and inflation. These governments, these national oil companies that are part of OPEC, they're so reliant on oil revenues, and then to balance their budgets, I mean, they need a higher oil price. I don't think the Saudis are happy with oil prices in the low 70s. I mean, there's a lot of hedge fund managers that are short oil futures contracts. A lot of it's global macro, what they're betting on global recession, and oil demand will fall, because that's the normal narrative in a recession, is that oil demand falls. But I don't think the Saudis are happy at current prices. I think the Saudis want oil prices at least at 85, maybe $90 per barrel. I don't know if they want it at 100 or 110 because then there's demand destruction, but they're not happy at the current prices. So I could see the Saudis, if oil prices, Brent prices go substantially lower, I could see them wanting to cut even further soon.
Yeah, you bet. And I think that this is one of the big things that is at the forefront of the structural oil bull thesis is that OPEC has to be back in control of the oil markets. And OPEC today is largely dictated by where Saudi Arabia wants to control them, especially given that Saudi Arabia themselves are willing to be the sole cut or the one that's taken the brunt of the cuts in order to ensure that the global oil markets are in some sort of sustained, controlled fashion. So I think going forward, you will see them taking more and more control. And this is something they've been trying to do for 10 years. I mean, before 2014, they were maintaining some spare capacity in the market. They were not producing all out, flat out. They were trying to ensure that there's more investment going in. They were trying to slowly bleed the spare capacity back on the market in order to keep oil prices from absolutely skyrocketing. And going forward, I think you're going to see the same mandate with the way that U.S. shale has slightly slowed down. I think 2023 was a very interesting year for us oil bulls because U.S. shale was able to continue growing, a large part of it due to longer laterals, more proppants in their completions. We saw a large part of the DUC count come down. We saw oil production in the Bakken and then the Gulf of Mexico as well rise pretty substantially year over year. So a lot of factors resulting in a quote unquote one-time gain in 2023, which is expected to slow down in 2024 materially, especially with the big private companies getting bought out here in the latter half of 2023. We see the big growers, Endeavor, Crown Rock, getting bought out, as well as some major M&A in the shale space anyway, which is resulting in a new slow growth environment, therefore resulting in OPEC and OPEC Plus being back in control. So the more they're in control, the more they can dictate how markets flow, and I think that's what Saudi Arabia has been wanting for many years. And I think a add-on to that is, as you mentioned, there's a large part of this is due to financial market stress. So we see the net oil positioning being at decade plus lows, and a large part of it is not necessarily because people are not willing to bet on higher oil prices. It's because the cost of doing so is just exorbitantly high compared to where it was for the last 10 years. So you take margin interest requirements and rates from 3% to 7 to 8%, and it just makes people gun shy. They don't want to bet on it. And so we're seeing the paper markets really not supporting the physical markets in terms of where oil prices can and should go. And the prime example of this was back in September, October timeframe, where prices rallied from the high 60s all the way to $94 a barrel in almost no time. Given that there was some geopolitical tension developing, and really it didn't take very much. It took oil positioning moving from a 2 or 3 percentile to about a 40-45 percentile to bring oil prices there. So what would happen if the net futures paper positioning went to 70 or 80th percentile? You can see how fast the markets can move, given that we have just very low participation in the market. We've got oil barrels in the physical market at many year lows. That is global, that is in the US, that is the Strategic Petroleum Reserve. We don't have the insurance policies anymore that we had 3 to 4 years ago. So things sets up for a very juicy market where we have a very strong floor built in, and then we have the upside that so far nobody's willing to push that snowball down the hill. But as soon as that snowball starts rolling, it just starts rolling. There's nothing there to stop it on the other side, other than, of course, OPEC spare capacity, which they've very properly built up because they realize where the market's going. And if there's nobody there, even at $100, $110 to stop it, well, then this thing goes off the cliff. So they are sort of your last case insurance policy, which is very much required. And again, back to the main point, we're back to a system we were in 2010. People seem to believe that we need zero spare capacity globally in order to get to a higher oil price environment. Well, we had about 4.5 million barrels of spare capacity in the worldwide markets in 2010. So this is not something that's out of the norm. This is something that OPEC has strategically put themselves into this position and given themselves more control of the market, both upwards and downwards. I think it's going to end up being better for the world, even though the whole OPEC is the big bad bear seems to be the common prevailing narrative.
So in terms of OPEC spare capacity, is it only the Saudis that have a sizable amount of spare capacity? Because a lot of these other OPEC and OPEC plus countries, aren't they drastically missing their production quotas? I mean, they're missing their production quotas for the last year or two by a lot, right?
Yeah, there is certainly some countries that are suffering. Angola, Nigeria. We see Kuwait in some cases not able to meet their quotas. But at the same time, I think we need to be careful. There's within OPEC, there's a large deviation between the type of countries that are there. So when you look at Saudi Arabia, probably we're talking about a million and a half of spare capacity. That would be your normal spare capacity in a surge capacity situation. They have produced 11 million barrels a day for a couple of months in a row, but are they going to want to do that? I don't believe so. On the other hand, you've got the United Arab Emirates has spent a lot of money on building up a excess cushion. So I would argue there's about a million barrels of spare capacity there. And I would say Iraq is your other one that's sort of they've been overproducing now for 5 to 6 months in a row, and they seem to have some excess barrels, especially from the Kurdistan region, which there's a bit of dispute going on. But either way, they do have some capacity there. And then on the other side, it seems like Iran has come back quite a bit. They're up about a million barrels per day from 2 years ago. So they have brought back a lot of that on the market already. We've got Kuwait with their major Bargan field, which seems to be showing its age at this point in time. And then you've got the other OPEC countries that are really not able to meet their quotas in most cases. And there's some that are just pumping away at exactly at the quota. So Iran, we got Kuwait, for example. We have some of the other African countries, along with Russia as well, is right at quota at the moment. So kind of a dynamic mix between the group, and overall OPEC plus as a whole is missing their quotas. But they've also reduced that with these new voluntary cuts that have come in. So I think all in all, they have a pretty good idea of where they are at the moment. And I would expect that Saudi Arabia to be the first one to add barrels, followed by likely the UAE, and then Iraq maybe getting some excess capacity there. And really, it seems like the UAE has become Saudi Arabia's smaller cousin in this case, because they have been restricting their capacity quite materially, given that they have some of the newest fields in OPEC plus, with Saudi Arabia, Kuwait, Iraq, Iran having fields all the way back from the 60s and 70s that have been pumping away for quite a while, and are definitely showing their age in certain cases, these super giant fields, as they call them.
When there was that Ukraine price spike, the geopolitical risk price spike, and we had the huge price spike in oil, did a lot of these national oil companies in OPEC, did they take that extra free cash flow, the windfall profits, did they reinvest that into capex, or was there a lack of capex investment besides Saudi Aramco into a lot of their oil operations and refineries?
Yeah, so I'm not 100% sure on this one, but I want to say that there was no real extra capex that got put in. There was no belief, I would say, that this oil price was going to last. You saw, especially in America and Canada, what's happened is that they paid back debt. They've really strengthened their balance sheets during that time frame, and I expect that the OPEC countries have done something very similar. They seem to maintain a relatively stable budget year after year. We did see Aramco come out with their 2024 budget, and even though they cut some of their spending because they're changing up their maximum sustainable capacity from 13 million to 12 million, they still are coming out with a higher budget this year. So they are going to be spending more money to keep their legacy fields where they are, and that's just a worldwide phenomenon. It's just taking more money and more resources in order to mitigate these decline rates, given the fields are getting older and older. So as far as excess money that was spent, I cannot say that in 2022 there was any large projects that were sanctioned. Potentially some of the smaller projects of debottlenecking and bringing some old wells back that we saw worldwide happened, because at $120 oil, you can just about make any oil field work, even if you got to spend money up front to get it back running. But as far as any excess spending, I really don't think we saw it really anywhere in the world. It was more of a, hey, we've got this one time, or we've got this right now windfall happening. We don't know how long it's going to last. It may last for a long time, but at this point, we're going to use the dollars to go and strengthen our balance sheets. We're going to try and get investors back with some dividends, and we're going to buy back our shares while they're trading at 2, 3, 4 times cash flow in certain cases, especially when the price of oil went that high. So I think really a lot of internal work was done within these companies as opposed to any major external work. And hey, a lot of these companies, you see what they're doing now. They're spending money on acquisitions. They go and say, hey, we've got a nice inventory of projects that are economic. They throw off free cash flow. They have high IRRs, but our competitor is trading at 60% of our value. So why don't we just issue shares and go and buy them out instead? That's why you're seeing massive consolidation. Companies that have been around for 20, 30, 40, 60 years, Endeavor, Hess, that are getting bought out. And this is not commonplace. This is a very mature industry at this point, and it's going to become even more consolidated into smaller and smaller hands as time goes on, just because of, as you mentioned, the cost of operating these assets is getting higher, the regulatory burden is getting higher, the shareholder pressure is getting higher. They're trading at such cheap valuations that the dollar is better spent buying out their competitors than it is to go and put that dollar back in the ground, especially at a time when it's not easy to find oil. The number of exploration success is going lower, and the amount of inventory and really solid targets that these companies have is not that much. So why would they blow it in a $75 environment? They'll go and buy right now, and then as prices rise, they'll go and get these projects done in a higher price environment because there's not that many left. You're not out here with a bundle of jewels. There is certain companies that have that, especially for the size that they're at. But for the majority of the blue chips, I mean, they have 1 or 2 plays that really they have left. And yeah, I think for ExxonMobil, you're looking at Guyana, for example. They have sanctioned some of these projects, but they're also not moving at breakneck pace. They're just letting the production grow slowly, 150,000 barrels every year, and going into the oil bull cycle rather than going out and putting in huge amounts of capex right off the bat into the drill bit and into the ground.
And cost of capital is so much higher with the Federal Reserve Bank hiking interest rates. So because of cost of capital and interest rates, it just makes more sense to be efficient, focus on free cash flow, not use debt willy-nilly, go and buy discounted cash flow if you can with the mergers and acquisitions, like you said. And then if you do the mergers and acquisitions, you don't need to grow production for the sake of growing production. Smarter to be efficient. So I think, like you said, we're going to see a lot slower production growth because the companies are going to focus on profit margins and free cash flow instead because of cost of capital and interest rates.
Yeah, 100%. Yeah, I think interest rates are having a huge impact on what companies are doing, how much they're willing to borrow going forward. They really want this debt paid back, and it seems like it's a way to get investor appetite back into the sector as well. We've seen countless bankruptcies and Chapter 11s and just issues with these corporations over the past 10 years. That the way to get them back is really say, you know what, look, we're debt-free company. Something like EOG, if I'm not mistaken, has $5 billion of cash on the balance sheet, and they're just sitting there and saying, look, this is kind of a waste that we're keeping this dollar where it is, but also we are essentially bulletproof down to whatever dollar WTI, and we would still be cash flow positive or cash flow neutral while having no debt maturities that are going to be coming up. And to your point about production, I think that's absolutely bang on. Is they go and buy these companies, and they're not out there to buy these companies and then go and jack up barrels within these companies. They're buying them. They're either keeping production flat, or in some cases, they're massively reducing activity because they bought these companies for future inventory and to keep them at a much higher production level. This is especially true for the shale space. Is just not a consistent, feasible thing to do because there is only so much inventory that's left. So they'll buy them, they'll drop 30% of the rigs, they'll keep production at a lower level, and they'll just sort of chug along and start generating material cash flow and material free cash flow out of these assets. So it's really a good place to be as an acquirer. You're able to buy things relatively cheaper than the previous cycles, much cheaper, I would argue, in certain cases. And I think companies that have the debt capacity, or they have the cash on the books, or they have a stronger share price, which we're seeing material differences in the cash flow multiples between blue chips, large caps, mid caps, and small caps they're able to buy their peers out for what they consider a discount because their shares are trading just so much stronger. And yeah, they'll go and buy back 20% of their float over 2 years, then they'll go and acquire something for 20% of their float, and they're essentially back to where they were. But a company that could be 30, 40, 50% larger, both in terms of reserves and production, and also in terms of the drilling locations, which is really going to be a major discussion point going forward, is which companies have good quality inventory and which companies have inventory, which is tier 3, tier 4, tier 5. And hey, it still may make money in a $100 oil environment, but you're going to start to see diminishing returns from an equity standpoint and what they can provide. Plus, of course, the amount of capital that has to go back to keep your production flat. So yeah, I think this is going to be one of the big narratives over the next few years as this cycle continues, is who can actually go and produce the barrels they have, and who can grow production, and who's going to be out there producing essentially a blowdown asset, because they're just suffering from inventory quality issues. And it may not have been obvious 2 years ago. It's somewhat obvious today, and it's going to become even more obvious as the months and the quarters go by.
I also think the new issue for Permian Basin production growth that's going to slow down the rig count is the natural gas price collapsing in the last couple of months down to $1.70. I mean, even the lowest cost natural gas producer, EQT, I'm sure they're hedged for a little bit going forward. I think the futures curve has natural gas above $3 over the next couple of years. But if the natural gas price stays at these levels, I mean, there's not a lot of incentive with some of these shale oil wells, which have 30% or more natural gas, a lot of natural gas liquids. If they're not getting a good price on 30% or more of all the energy coming out of the wells drilled, it doesn't make sense to keep bringing on new production.
Yeah, for sure. It's a compounding issue, I would argue. The natural gas price, especially the Waha gas price, which a lot of the Permian producers are exposed to, is definitely a major concern. And it's one of many concerns that are adding to where the Permian goes. So I think along with that, you've obviously got your well productivity that's been degrading over the last couple of years. So something that's kind of been missed is look, yes, the wells were getting longer. They've been getting longer since 2014. We agree to that point. But 2021, 2022 were the first years where that productivity per lateral foot actually started dropping. And in certain cases, the productivity in general, even though the wells were getting longer, has started dropping. And then it's not really fair to go and take the entire Permian and put it into one basket. You really have to do a county by county analysis. You have to do a company by company analysis and see which producers are in general suffering and which producers are maybe bucking the trend and they're going out and drilling even better wells. So
are you saying, sorry to interrupt you, are you saying so those guys, the ones who are doing drilling better wells, are those the ones that have more concentrations in, say, oil and natural gas liquids and less pure natural gas?
Yes. There is companies that have kept their juicy inventory a lot better preserved, and they're in more of the oily areas. So when you look at Lee County and look at Eddy County in New Mexico, there's some monster wells, especially right where that state line is. You've got companies like Oxy and EOG that have some absolute banger wells there. And they've got a company like Devon that went and blew that inventory in 2019, 2020, and now they have very less of that inventory left. So they're suffering in terms of your average well productivity. So I think there's a case to be made that if you're going to be a Permian investor, you really need to look at your company in particular and where the well results are going. And the data today is by far exponentially superior than there was 5 to 7 years ago. There's platforms out there that'll aggregate everything for you, put it on a nice Power BI, and you can look at things updated on a day-to-day or on a month-by-month basis. And there's no excuse if you're going to be putting significant amounts of capital into these players. There's no excuse for not going out and doing this sort of analysis. But in general, yes, the overall productivity of the Permian is dropping, but you really need to do a specific analysis area by area, because there is areas that have been growing very fast. And then if they're the ones suffering from the most productivity degradation, you can say, okay, the overall basin is actually going to hurt more, because wherever the growth was coming from, which is the Delaware portion of the Permian, is seeing a even bigger productivity loss as time goes on here. So I really think those issues, along with some gas takeaway problems, we are also seeing companies move into some of the more higher water cut and higher gas areas of the Permian. We look at Eastern Howard County, where companies like High Peak and Bayswater Surge Operating Co. are out there. These areas are just infrastructure constrained. They have more sour gas. They have a more problem with water takeaway. So a lot of the areas where these barrels are now going to grow from have other significant constraints to them growing from that area, compared to areas like Midland and Odessa and the main parts of the Delaware Basin, where there's significant infrastructure already in place from the conventional Permian days. And just because they're closer to bigger towns, so you're able to get services, you're able to get infrastructure built a lot faster. So I think there's a lot of headwinds to the Permian. I will give it to the Permian E&Ps. They have been nothing short of a absolute miracle what they've done here. They produced 5.5 to 6 million barrels per day today. We're talking just raw oil, crude oil, along with another probably a couple million barrels at this point of NGL liquids on top of that. So what they've done is absolutely fantastic. But this comes down to a case of capital deployment. When you deploy too much capital and you grow something too fast, you're unable to sustain it, because the decline rates on the legacy decline rates are something like 35 to 38%, I want to say, as a whole. It might even be higher than that. So you need to put that dollar back into the ground every year just to keep production flat. And the higher production base you have, the more barrels you got to make up. So I think this is something that really they've done an exceptional job at pushing this curve back further than we had thought. And I think the shale bears have gone absolutely decimated, especially pre-COVID, but also in some cases post-COVID. That being said, the jury is still out there. The Grim Reaper is just waiting on the other side. They have not passed away. They're there waiting to put their Skype into these companies. So I think you're seeing the early stages of certain companies. I mentioned Devon here, that are really, really suffering from a major productivity degradation, and you're seeing other companies acquire their way out of that, and I think rightfully so. Like for example, you look at what was paid for Endeavor. They were bought out for $130,000 per flowing barrel of oil. That's US dollars. That is a huge premium to pay. And yes, a large portion of the acquisition was for undrilled locations. But when you look at what was paid on a per barrel basis, you're seeing in some cases companies getting bought out for 5 to 6 times the value of their similar Canadian producer in that environment. So I think valuations have really gotten through the roof because of the aforementioned issues with the Permian legacy production as it is. But don't let me be the one to tell you that, oh, the Permian sucks. Like this is a world-class basin. And the question is what happens on the other side? Because not only does the Permian have to maintain production, but remember, this is the basin responsible for about 80% of the world's oil supply growth over the last, let's say, 7 to 10 years. So if it's not growing, that in essence is a problem for the world oil supply, let alone what happens if the Permian starts to degrade and lose barrels. Now you have a double whammy issue, which I think, again, that along with the OPEC in control are the two fundamental baseline principles of the structural bull market. If you are believing in a structural bull market, those are the two aspects that you have to believe and that have to come to fruition over the next X amount of years for you to generate the returns that I think some of us are looking for in this cycle over the next few years.
Do you think the stuff you just outlined in the last couple of minutes is exactly what the CEO of Occidental Petroleum is looking at when she said that there's going to be an oil shortage in 2025 and 2026?
I think it's a large portion of it. Yes, the world has almost gone caught in this boy who cried wolf situation, where we've been talking about shale declines, and they just haven't come. Then we talk about 2023 that there are going to be shale declines, and they just haven't come. Well, now what's happened is the people have told the boy, hey, you're just a liar. You got to stop crying wolf. But what's happened in the meantime, there's a whole pack of wolves that's now going to be attacking this village all at once. So meanwhile, the people there are just doodly-doo, chilling out, not really focused or prepared for what's coming. Meanwhile, there's warning signs that are way behind the scenes, going out and alarming. So again, this is not something that's going to happen tomorrow overnight. The entire industry collapses, but all you have to do is go look at what happened in 2020 when a lot of these rigs got shut down, when a lot of the completion crews got shut down. Some barrels were also shut in, for real. But when we look at where and how fast the Permian production dropped, that is not necessarily what's coming, but that's going to be a some percentage of that is what's on the other side of this. Is there's a large number of barrels that's under high decline rates, that's under constant degradation, and maybe 2025 is the year, maybe 2026 is the year, but again, you've got a world that continues to grow 1 million barrels per day, basically, no matter what happens globally. And you've got something that's responsible for 80% of that growth on the supply side, that not only could it stop growing, it could start declining, and you can come up to a major shortage. I think part of what she's saying has to do with the fact that over the next, let's say, 12 to 18 months, you've got a large block of OPEC spare capacity that's willing to come back onto the market at the right price, therefore allowing us not to be in a shortage situation. But what happens on the other side of that? And that's really, I think, where maybe the 2025, 2026 comment comes in. But this is something that Scott Sheffield at Pioneer has been talking about. This is something that has been talked about by many of these major Permian producers. They are talking about what's coming, and ask yourself, if they really saw $100-$150 oil coming over the next whatever amount of years, why are they selling out? I think there's some push from the markets that, look, your inventory itself is actually not looking very good. So over the next couple of years, you may want to sell right now while the market's pushing you, and while you're trading at $100 oil valuation anyway, you should sell out rather than wait for it, because by then your inventory might degrade it another 20, 30, 40%, and now you're in a much worse position than you would be to sell now. So kind of a double-sided argument, I guess, in some ways. But the valuations of $130,000 a flowing barrel, that's definitely a $100+ oil valuation that these companies are getting on the buyouts. So I think the world is very polarized on this topic, and there is, one could argue, a complete frustration on one side. There's a complete apathy on the one side and lack of information on the one side. And on the other side, you have some educated guesses being made that have so far been not quite true, but it doesn't take long for that to completely reverse. And I think that's really the main point to be made here, is it doesn't take long for that entire argument to completely reverse and become 120% accurate. And at that point, it's almost too late, because now you haven't put the money in on the investment side. So it's going to take a period of time for that oil supply to come online. While during that time frame is when we make our riches, and bags of money is the hope and the investment thesis anyway.
Yeah, and at current natural gas prices, U.S. natural gas prices, despite where the futures curve is, I mean, there's not a lot of incentive to rapidly grow production, especially if the basin that they're drilling, like you said, has a lot of natural gas, 30% or more natural gas. Not a lot of incentive to quickly grow production when the natural gas prices are so low. We're going to start seeing, I believe, where the rig count fall even more in those areas where a lot of those wells have a lot of natural gas coming out. It's just not economic incentive to be drilling those types of wells right now.
Yes. Yeah, no, 100%. And you're already seeing this in the Q4 reports and the 2024 guidance and commentary. You're already seeing companies say, look, we are going to stop growing production. We're going to hold production flat. There's certain producers that have said we're going to actually go down in production. And again, this is both natural gas focused producers, also the Permian gassy producers, and then the Permian oily producers. All three buckets of that are saying the same thing. And then you've got companies, I just mentioned High Peak here a while ago. This is a company that grew 79% year over year in 2023. So their barrels of oil grew 79% from 2022 to 2023. What are they guiding for 2024? A production decline of 10%. So when I say things can reverse overnight, or not overnight, things can reverse in a very short period of time, I'm not talking about them going from 80% growth to 40% growth. I'm talking about them going from 79% growth to a 10% production decline. That is the change in narrative. That is a change in the company's business plans, and that is a change in the company's production profile going forward. And this is a company that just started growing production. Now look at companies that have been at it for 5, 7, 10 years. They're much further down the productivity degradation scale. And company, again, just to compare and throw some facts out there, a company like High Peak has about 80% of their corporate production is oil. A company like Pioneer, roughly half of their production is oil at this point. So you're right, half those barrels are getting zero value, may even be net negative, depending on the cost to process and transport and gather this gas. And that number just continues to go up. The total number of BOEs versus the growth in oil in that basin, we're starting to see trends change, and they've been changing for a while, especially in some of these legacy companies. So more and more production becomes gas, and more production becomes low value BOEs. And this is why I just get so it's both frustrating and it's both humor to see Chevron go out and say, oh, we're going to be 1 million BOEs by 2020 this. It's like, okay, well, tell us how many barrels of oil you're going to be. I don't want to know how many butane barrels you have. I don't want to know how many pentane you're producing or how much natural gas you're producing. We need to know oil barrels. And lo and behold, they won't reveal that, nor will they make a claim about how many oil barrels they're going to be at. Same thing with these acquisitions. You see these acquisitions, you go to the corporate PowerPoint that's detailing the acquisition, and oh, we're a top 5 producer of the Permian, but you're producing 750,000 BOEs. You're not talking about how much oil you're producing. So why are they going that way? Well, you know the answer, because the gas is a worthless product in most times that can be used as a way to show company size and justify your valuation when it's not really a high value product. Even at $3 gas and then you put the Waha Basin pricing on it, along with the transportation and the gathering fees and the processing, that gas molecule is not worth all that much. But the Permian producers are after oil, so they will value everything on oil. But again, to your point, we're moving towards basin areas with lower and lower oil and more gas percentage. And the same applies for the Eagle Ford as well. I mean, this is the Eagle Ford, and this is a Permian issue that sort of convoluted things a bit. But further pressure on the oil rigs and the gas rigs going forward due to the lower price of natural gas.
So I want to transition now to your specialty, which is oil and natural gas, which is Canadian oil and natural gas stocks. And you've produced very good returns in a short amount of time, despite different market conditions. Now, I was an oil and natural gas analyst for my listeners out there. I did cover some of these stocks in the past. In the past, a lot of these companies, their oil was what Western Canadian Select and other blends. It used to trade at a big discount to West Texas Intermediate because the oil was landlocked or couldn't get to the coast or there wasn't a pipeline. Do you think, and some of these Canadian oil and natural gas companies right now are trading at a 30% to 50% discount to net asset value? So they're very, very cheap on a valuation metric. What do you think can change their valuation metrics and re-rating for multiples? Is there going to be new pipeline capacity in Canada that's going to unlock this oil and it's going to be sold at a higher price soon?
Oh, 100%. The multi-billions of dollar question, I think that we've been trying to answer for the last 10 years, but even more so over the last 3 years, let's say. So kind of a quick reminder that we are now today trading at a higher price in terms of Canadian dollar WTI than we were for 2010 to 2014. So you take the $80, $78 WTI, you put a 1.36 exchange rate on it, and we are trading higher than we were in 2010 to 14 when prices were $100 WTI, but the exchange rate was 1-to-1. So some of these companies are generating more today on a revenue basis for that barrel than they were back then. However, the market doesn't care. Why? Because there's some fundamental misunderstandings about the Canadian sector. There is a complete misunderstanding, I think, of the egress issue. Nobody is to blame here except the producers themselves. They have not done a good job telling people about the Line 3 replacement activities that have gone on. The Enbridge Line 3 got replaced. It has added multi-hundreds of thousands of barrels of capacity going down to the US this has solved a lot of the problems over the last couple of years with egress. However, you're still dependent on the US and the US refiners, especially the ones in the Chicago, Illinois area that are processing a lot of heavy WCS barrels. The Trans Mountain Pipeline expansion, this is something that's gone from a $10 billion cost to a $35 billion cost because it got taken over by the Canadian government, and we all know what the story is there, and hampered by constant delays. However, we do finally see light at the end of the tunnel. We see an extra about 500,000 barrels of capacity coming online here over the next couple of months. Sounds like April is going to be your line fill. So barrels start entering the line. You have the barrels that are going to be in the line in a sense forever. And then we start filling the line into May and start commercial operations shortly thereafter. People in Canada have been fooled for many months waiting for this to happen. So I will wait until this actually happens to go and pop that champagne. At the same time, this is going to add access to the ports. So off the coast of Vancouver area, we're going to start seeing these vessels ship out. I think the upgraded capacity is about 900,000 barrels is what it ends up being after the expansion. So a pretty material portion of Canadian production is going to start looking at global markets and getting priced that way. And I think this is something that really, yes, maybe now was not the time, but as the months go on, I think we really need to do a good job at sharing this, given that the WCS discount today is not historically that high. It's about $15 a barrel. It's expected to go down to about $9 to $10 a barrel by the time that the TMX comes online. And remember, that's a WCS Hardisty price. When we look at WCS on the Gulf Coast, it's trading at somewhere near WTI with a slight quality discount on it. So we are seeing that grade of oil trade relatively higher, especially with the loss of barrels from Mexico, from Iraq, and from Venezuela. And of course, now we're going to lose some other Nigerian barrels as well, and Kuwaiti barrels, because they've started processing their own oil in their domestic refineries. So I think that's the first one. The second one is that, again, the producers have done a very poor job sharing their low decline rates and their relative asset quality, and the fact that they have way more inventory. I'm talking about the Canadian shale producers, the Montney, the Duvernay basins. They don't really go out and tell people how much inventory they have, how much high quality inventory they have. It's very difficult information to find. These companies are not active in the US funds flow market. I rarely see them at conferences in the US, which I've been attending, and they just prefer to be this, we just do our own thing. We don't need anybody to know who we are. We're a very good producer. Well, it doesn't matter. It's not a bunch of production engineers that invest in oil and gas companies. It's the financial markets, a lot of which is based on buzz and hype and exposure and getting out there in front of the money flows where they are. So I think really from a Canadian side, pushing for better information and communication is going to be the narrative going forward. Some of these companies have bought back 10% of their float for the last 3 years running, and it's made no change to the share price because all they are exit liquidity for people that are looking to move on and invest somewhere else. So I think there's a couple of fundamental truths about the sector that have changed compared to 5 years ago that need to be brought back. And then, of course, the government. The government of Canada has done no favors to the oil industry, but with this constant attacks on the industry, no support, and a somewhat bizarre way of going about it and pretending like the world cares about the country as a whole, in terms of their missions or their trade relations or their geopolitics. At the same time, attacking their own sector. So I think there's really some soul searching. I don't think it's going to happen. I think it's going to require a complete change of the government that's going to bring some investment dollars back. But I constantly hear complaints about how, somebody could come in and nationalize the industry tomorrow, or somebody could come in and completely destroy the industry tomorrow. Whereas the Alberta oil sector is relatively not that much different than the American oil sector in terms of the politics risk that it has to it, yet it gets priced as if it's going to be taken over tomorrow. So these are really broad-based, deep-rooted fundamental issues that the companies will need to address as the cycle goes on if they care about trading at any sort of reasonable multiple. You see companies that have moved and have now domiciled in the US. You've seen companies that have started putting their their tickers on the US side of things, and they see relatively better funds flow. They see relatively better trading volumes. They see better exposure to hedge funds and all sorts of other pension funds and just money in general because they're out there in the market. So I really think there's issues that have been resolved underneath, but they are not really visible on the surface, which is the resulting in a large part of this discount and can be fixed. And I think that's some of the work that we've been doing here, is just putting these into the highlight and saying, look, these are out there, but there's only so much work you can do from an external basis. You still need the companies to care enough, and you still need the governments and the money flows to care enough to go and actually put that dollar where it needs to go. So again, these things will be solved as prices get higher. These things will be solved hopefully with a governmental change. They'll be solved with some better exposure to the egress issue being resolved, and they will be solved just with the companies themselves consuming themselves, meaning M&A plus the share buybacks and the reduction in share count, which has already been going on, but I think needs to be accelerated even further, especially as some of these companies are now completely debt-free moving forward. So we're seeing this slowly occur, but it's just taking a bit longer. And again, we're in a world now where people, if they invest in something for 3 or 6 months, that is a long-term investment to them. So we really need some of these companies to share their story a lot better and allow themselves to get re-rated, at which point they can then go and continue working on their internal initiatives and benefit from the better valuations, whether that's a reduction in cost of capital, whether that's a ability to go and acquire more properties or buy out their peers. Whatever benefits you can get out of that, I think are quite major. So as well as just a personal pride in what you're trading at. If you have a best-in-class world-class business and you're trading at 3 times cash flow, what are you really doing? Like you need to show people what you are. If not, you should just remain private and just stay there, and you can continue to do your own thing behind the scenes. So yeah, to your point, there's a lot of things that have been fixed. There is still some work to do in the sector. There is still some companies that are growing production and delineating properties, but in general, by far and large, the Canadian producers when I look for skewed risk reward, the Canadian producers are where we have it. The upstream E&Ps is where you're seeing the most skew in terms of risk reward. And again, just to reiterate, they are getting $110 a barrel compared to $80 a barrel because they're getting the price of oil in Canadian dollars on the top line, which is what they report in. So very, very strong companies. And I think work still needs to be done both externally and internally to go and get that discount a little bit lower. And of course, the company's just generating more cash because of these new pipelines and more egress, and better exposure is going to help regardless in terms of what they can do to help themselves through higher dividends or through buying back more shares per year.
I'd also say the attitude for a lot of Canadian investors, and I've been covering gold mining stocks and natural resource stocks for almost 15 years now, and it was my day job for oil and natural gas stocks too, but also gold stocks. The attitude for a lot of Canadian investors has changed a lot the last 10, 15 years. When I started covering a lot of these companies and interviewing experts like you and mining stock experts like Rick Rule and many others, there was a lot of Canadians that were interested in these companies. And over the last 10 years, I'd say a lot of that interest has faded away. A lot of the Canadian merchant banks has gone away. These mining stock ETFs has taken capital out of the sector. So a lot of these Canadian investors, they seem to be more interested now in US technology stocks, Bitcoin, rather than any of these natural resource stocks, whether it's the improving fundamentals of these oil and natural gas companies with dividend yield. Like you said, they're not really interested in those because they're not going up like Bitcoin is, or technology stocks or Mag 7 or artificial intelligence stocks in the United States. And they're not interested in gold mining stocks right now.
Yeah, and that just speaks to the exposure once again. People see these companies as boring. There's nothing going on. Why would I buy this for 7% dividend? They don't really care to understand the oil macro cycle. and where we are in it, it's very difficult to find information about oil and gas in general, and kind of whether it's the macro or the companies themselves, or whether it's a little bit more understanding of the way that oil works, just as a commodity, or as an engineering subject. These companies have done themselves no favors. They just sit there and they just continue on, and it's all about exposure, right? Like I would argue a lot of people know nothing about AI or Bitcoin or tech stocks either, but it's just
They're buying the chart, man.
there.
They're
Yeah,
buying
it's
whatever's
there.
it's greater fool theory. It's a tech
Yeah,
bubble. They're buying
yeah,
whatever's
it's
going up.
correct. Yeah, it's there. It's in front of their eyes. It's easily explained. Whether that explanation is actually true or the correct complex explanation you should be giving somebody, I think that's to your subjective view. But it's just there. It's out there. It's this big sexy thing that people like, and that's where money funds flows. That's the reality of it. And you kind of hit the nail on the head there. Is that there is no more merchant banks. There is no more private equity. The Canadian banks themselves have, in some cases, refused to buy large portions of these E&Ps, other than maybe the blue chips of the blue chips. And these small to mid caps are just completely suffering from investor apathy. So what do they need to do? They need to find capital. They need to find large bases of shareholders that will come in and buy these corporations and take a 5, 7, 8% stake and just leave it there for 5 years and just let it run. So I think a lot of work needs to be done by these companies in order to do that. I mean, it's not necessarily retail investors that's going to come in and bring your price higher, but it's a retail investor whose dad works at a XYZ private equity, or whose mom is running this or that, and it's really all about exposure. What can you get out there so that people know what it's doing? And we say bubble on certain things, but some of these bubbles last forever because they just keep the exposure out there to the point that these companies can trade at very, very high multiples compared to other sectors. So so I think it's all about exposure. And I will say oil is not a very, very attractive thing in a $75 oil environment. In a 80, 90, $100 oil environment, does it get relatively very easy to go and market oil and be out there? Sure. But that doesn't mean that you shouldn't be out there preparing for that, or you shouldn't be out there sharing information regardless, as to what's going on in the sector. So I think that's where a lot of the work needs to be done, setting up for this oil cycle. Because once we're at $100 oil, it'll be slapped all over Bloomberg and CNBC and Reuters, and people will come back to the sector. But which companies are they going to buy? Well, they're going to buy the companies that have the most exposure, and the companies with the most exposure need to do it now. They don't need to go and do it when we're already there. They need to be out there, and they need to be visible, and just out there with clear, transparent information about what they're doing and their business plan, and proper reporting, so that when that XYZ investor comes back, they can easily find the companies that are out there, and they can do their own internal calculation and say, yeah, this is actually a relatively good play, and let's buy X amount of the stock, and we're happy to let it sit for a little while. So a lot of PTSD in this sector. So there is some recovery that needs to be done as well there. But yeah, we rarely hear about somebody that's talking to me about oil stocks. I constantly getting bombarded about other names and other sectors and these other investment opportunities out there. Well, we can go and sit here and say, oh, we in the oil sector, we don't like to market ourselves because it would be wrong, because it would lead to a pump and dump or whatever. Well, if there's other sectors out there marketing themselves without being pumps and dumps, then why can't we do it, right? We're not out here trying to spread false rumors about what the companies are, or we're saying we have oil when we don't. We're telling you the truth about what these companies are, the cash flows they produce, and the commodity they produce, and the macro of the commodity. Yes, there's a bit of subjectivity to it always, as there always is, right? We're humans, but at the same time, I think getting better exposure out there is really a fantastic way. And yeah, I talk to people day in, day out. I go to a lot of networking events that are non-oil related, and I talk to people day in, day out about oil and the investments. And certain people care and certain people don't care. But what can one person do? You ask, and it's like, well, this is just my passion. I like sharing what I invest in. And I think it's all about starting that snowball effect, because all of this starts somewhere, right? Like Bitcoin, when it started, how many people knew about it? 5, 10 people, and then it just went from there. So over the last 10 years, look where it's gone. So
Well, I would also say sentiment wise, oil stocks are very out of favor. So it's contrarian value right now, along with a lot of gold stocks, gold mining stocks. So in terms of valuation, the fundamentals, like you said, I mean, people can buy good businesses with better balance sheets and a dividend yield and free cash flow. Yeah, it's not sexy like Bitcoin. It's not going up $1,000 a day like Bitcoin. But then again, Bitcoin also has insane volatility. It could also go down $1,000 or more a day.
yes, and I think that's in some sense, that's where we are, because oil stocks went really high in 2012, 2014, then they went really high in 2022, and then they collapsed. And now some people are suffering from that same problem, but there's a large pool of people that have never invested in oil stocks. So yeah, so you're right. The when you look at raw fundamentals, that's what we're looking for. And I know there's capital out there because I found it for our portfolio company investments. Yeah, we're not talking about huge companies, but we're talking about 30, 40, $50 million companies. I've personally found pools of capital that have gone in and bought 8% and 5% of these equities, just by being out there and visible, and it's provided a lot more structure to these corporations, even in a lower oil price environment. And God knows what that can do in a higher oil price environment, because they're out talking to their friends, and they're out talking to other hedge fund managers and other private equity and other family offices. The system has been set up to succeed in a higher oil price environment. And I don't know why other companies don't do it, because the pools of capital is there. There's so much money floating around in this world today that doesn't know what to do with it, that it's even shocked me, because I thought everybody would put their money in a T-bill, 5.5%, bam, tax-free, I'm happy. And it sounds like that is not the case at all. People are looking to remove that money from that T-bill account and go and put it into other propositions and investments that can make more money. They just need a reason to do so. And all we got to do is go out and find it, because this sector needs it. And without that, we're just going to stay here, wither away, or we're going to buy ourselves back to the point that there's no shares left, which I don't think is the right way to go about it. I think there's better value in going out and building up a strong shareholder base that trusts you and believe in you while you continue to execute on your business plan. That's the whole reason to go public in the first place. So yeah, I think there's a lot of opportunity here. I'll put it that way, that even though we are at these multiples, and even though we are in a somewhat lower oil price environment, relative to where we were 2 years ago, that just creates a sense of opportunity, that the right companies that can execute on the plan to be visible and transparent and get exposure are going to succeed materially so going forward.
And you're fully transparent. You have your portfolio, your White Tundra portfolio that you manage, and also your personal oil and natural gas company portfolio on your website. Now, before we started recording, you talked about dark pools and naked shorting these block trades. Is there a lot of naked shorting of these Canadian oil and natural gas stocks that despite the fundamentals, there's a lot of short-term traders that think, oh, the global economy is going into recession, I'm going to scalp 20, 30% shorting these companies. Is there a lot of that going on right now?
Yes. So I can't speak to exactly who's doing it, nor can I speak to what their mandate is. But I have had companies, and again, we under White Tundra, like we invest in smaller, leveraged, high torque E&Ps. So you see a lot of traders enter these names. You see a lot of short-term scalpers enter these names. You see a lot of people enter these names with no understanding of the company at all. It just because it screens a certain way on a certain list. And there's been large volumes that I personally have bought. There's been large volumes that I've been informed that other investors have bought on the public markets that just don't show up. They just don't show up on the volumes. And this is not a one-time thing. This is something that's been going on for the last 2 years. I even saw this back in 2020 when I was out there. I was buying companies that are now billion-dollar companies. I was buying them at their $50 to $100 million valuations. Similarly, so where I am today, where I saw the same thing: pools where the volume just didn't show up. We saw different mechanisms where 100 share blocks would trade every 15 seconds in order to keep that price down. So you could go and buy 10,000 shares at 5 cents above, but then that same 100-share block would push the price back down because there is no market maker per se that's on the bid side of the equation. So I think we're going to continue to suffer in some sense here. There's ways to solve this problem. Yes, you have your securities commission way, which is relatively ineffective. You've got your way of just brute forcing the thing through by buying huge volumes of the stock. That may be something that smaller investors can't do, but it's something that some major player that comes in would be able to do. You've got ways of block trading large stocks and keeping them outside the free float, which is what I described, that I've been working with some of our portfolio companies to do the same. That I think is a very attractive proposition, but I think it's up to us to solve this. The junior gold miners, the junior oil and gas, even some of the small cap oil and gas suffer from this problem. We can go out and scream manipulation from the rooftops, and it just goes into the void. So I think there's ways to make it so that your portfolio company is unattractive to shorting, it's unattractive to scalpers, and we're working very hard with our portfolio companies in order to make it so. There's been some nefarious activity, I think, regardless, over the last couple of years, but going forward, this needs to be addressed because it's what's preventing us from trading at any sort of meaningful valuation. And if there's not enough buying power, well, people just keep selling and selling and selling into it, and there's nobody on the buying side. So, yeah, I think the same way that Saudi said that, hey, shorters are going to get burnt. I think in a $75 oil environment, it's not easy to go out and actually execute on that. But I will say, as the commodity prices rise, it's going to be very interesting to see how these smaller caps trade going forward, because it's the ones that go and address this problem, that are going to be able to get outside this little trading range and really get above it, where now people are not interested in dealing with this amount of money on the one side of the equation anymore. So yeah, but as far as dark pool activity, endless, absolutely endless dark pool activity in these names, and endless scalping and possibly naked shorting. I can't speak for that. Hard to say, because a lot of short volumes don't actually show up on the way that they're tracked. But I wouldn't be surprised if you see some massive moves up in these junior names, if we see a relatively nice sustained pop in oil price as the months go by, because there's so much shorts that need to be covered, or there's so much activity that needs to be covered, that the free flow just isn't there. So that's one of the great things about investing in these some of these smaller names is I've seen their patterns, I've seen the volumes come in and out. I've personally traded them anecdotally, and I can see traded as in bought, mostly bought, very low sales, but I've seen the activity, how it shows up on the TSX and how it shows up in my account is completely different. So yeah, I'm not going to go out and make any sort of statement, but I think it'll be very, very interesting to see how these equities react in as these large pools of money start to come in on the bid side, which again is my focus right now with the portfolio companies that we're involved in.
And maybe mergers and acquisitions will fix this. The companies already see that their shares are cheap and they're buying it back. They have free cash flow. So are all the companies that in the White Tundra portfolio, do they all pretty much have like a dividend yield above 3% and free cash flow?
Pretty much, I would say any public company that's out there, we are looking at a 4 to 5% dividend yield. Some of them slightly higher, as well as some sort of buyback mechanism or debt payback mechanism. That being said, the White Tundra portfolio has transitioned to more of a junior E&P play. So we are definitely backing more producers that are in a production growth sort of environment, as long as the capital efficiencies on that growth are very attractive. So we're talking bringing legacy pools back to life, optimizations of wells, working over wells, some new drilling as well, as long as it's 8 to 10 months or less in terms of the payout on it and a low decline rate. We're talking about huge OOIPs, so pools that have large original oil in place with very low recovery factors. So those companies don't necessarily pay dividends because that dividend is just not going anywhere. The people that are investing in these corporations are not investing in it for a 5% dividend. There's plenty of companies like that out there in the slightly bigger size that are available. So I think for our companies, we're pushing towards a production growth sort of mandate, or a complete debt reduction mandate. So if your company is 50% equity, 50% debt, over the next 2 years, you pay off all your debt. Well, you've essentially doubled your market cap on that company. So uh, in an absolute perfect world, every dollar of debt paid back should go back into the equity value of the corporation. So I think we're really backing companies more in that, because I see a much higher commodity price environment coming up, and I don't know if dividends today are really all that meaningful in terms of attracting people, because a 5% dividend, does it really mean all that much in a 5% Fed funds rate environment? I I think the answer to me is no. But to the investor that just wants to get their dividend every month, yeah, of course it means a lot. But again, there's already companies like that out there that are paying. In some cases, there's companies paying 12 to 13% dividends in the Canadian oil and gas sector. So I shouldn't discount what kind of dividends they're paying. There's some paying 12, 13% today. So yeah, I think it just depends on your portfolio construction and your mandate, and where you see returns in the sector. And I'm not saying that we're batting 1,000, uh, that we're batting 100% by any means, but we were able to generate the kind of returns we did in 2021 and 2022 because of the aggressive strategy. So people like to go and start saying, "Oh, well, if only you had been less aggressive, you would have been better." Well, we would have been better possibly over the last 18 months, but we would have never got to where we were in 2022 if we ran a much more conservative strategy. So the uh, the strategy works both ways. It's built to be an aggressive, high torque strategy, and yeah, I think that's been the mandate ever since day one, and it's going to continue to be the mandate despite some suffering, I'll say, over the last 12 to 18 to 24 months.
Yeah, oil and natural gas, all of them, other than ExxonMobil and Chevron, really, and Hess Oil and Marathon Oil, a few others are out of favor right now, especially the smaller ones. But we'll see how long the Federal Reserve Bank keeps interest rates this high. I mean, the next crisis is not that far away, I think, in the US with commercial real estate and regional banks. And then the Fed, there are already predictions they're going to cut rates at some point this year. I don't know if it's in a couple months or towards the end of the year, but something will break because of the way the banking system is here in the United States. And then the Fed will cut rates. And then I think we're going to see inflation come back in waves. And then I think people are going to want inflation hedges. They're going to want commodities traditionally. They're going to want exposure to gold stocks and oil stocks, especially if those oil companies have free cash flow or they've added reserves at relatively cheap valuation. So I think that will come back as the Fed cuts rates and people start to have inflation fears again.
Yeah, and I think this is a new world that we're in, right? We have oil supply demand on one side, we have the OPEC cuts on one side, we have the Fed funds on the one side, we have the paper markets versus the physical markets competing against each other in some manner here, and we've got the world that's it just come out of a severe recession, and we got so much more money in the system that nobody really knows. We're making educated bets on where things are going. I think the global economy has started 2024 very strongly, both anecdotally and also through some of the data points that are coming out. And physical oil demand doesn't necessarily follow the earnings of the S&P. Those two things are completely unrelated to each other. If Walmart's making less money, that's in fact better for oil companies because the consumer has more dollars to spend on other travel and gasoline. So you got to really shift your thinking a little bit when we talk about where things are going. So I really think that the global oil demand has been the one true kind of undisturbed number over the last 50 to 100 years. And yeah, how it all plays out is going to be very, very interesting, because the higher Fed funds rate doesn't seem to have made much impact on the physical oil market, but it seems to have made a substantial impact on the financial oil markets, paper markets. And as that balances itself out, it's going to be curious to see which side wins, because essentially the OPEC barrels that are off the market are a counter to the higher Fed funds rate. That's essentially what it is. And which of those cracks first, and where does the price of oil go in the meantime? And how much returns you make, again, is a major factor based on your portfolio construction within the sector. There's some companies over the last 1 year, they're up 75%. There's some companies that are down 25%. So, and you could say fundamentally, arguably those companies are not that far off, um, as far as what they do and the metrics that they have. So yeah, so it's going to be a very, very interesting next 6 to 12 months, especially with the election year coming up. So of course, gasoline is always on top of mind, gasoline and inflation. And how does the Fed react here at a time when, you know, by and large, a lot of the inflation is tied to shelter, and we are seeing slowdowns in other parts of the economy, but also some very, very, very strong numbers in other parts of the economy. So many factors. We try to bring this down to a simple 2 or 3 sentence answer, and it's usually not the case
Yeah, I agree.
that we can get there. So yeah, in the meantime, we just keep investing based on what we see best and where the again where the skewed risk rewards are, and yeah, over time that generally tends out to work, as long as you were correct most of the time as to what your investing thesis was.
And I don't think the White House can keep dumping strategic petroleum reserve oil onto the market because it's already cut in half to get the gasoline prices down for the election. I mean, I guess technically they could do it a little bit more, but they're going to run out of strategic petroleum reserve, and global inventories are already, I think you said earlier in the interview, towards multi-decade lows. So there are fundamental factors versus the oil paper markets with cost of capital and interest rates. I want to thank you so much for your time, Shubham, today. My listeners want to follow your work. How do they do so?
Yeah, I think most active on Twitter at White Tundra SG. Also on my website, whitetundra.ca. Taken a few months off actually for the last 4 to 6 months, just with the oil market being in a bit of a lull for that period. But going to be back on here very strongly with my Zoom sessions as well. So probably twice a month, Sundays, we do a Zoom talking about geology, we talk about engineering, valuations, oil macro, supply, demand, airline travel, sort of any and all topics. So we're going to be back on that. They're completely free. The recordings of that are on YouTube. So again, at White Tundra SG, I believe as well. If you go, you can look at all the YouTubes in the past of the Zoom sessions that have been recorded. And yeah, I think those are the best. I've got a little contact page on my form. I've got a contact form page on the website as well. If you've got any questions regarding the interview or anything else in particular, you can go on there. And yeah, pretty active. I try to reply to a lot of the DMs and emails I receive. So far, I'm kind of a couple months behind right now on that, but yeah, we'll keep on chatting. I could talk oil 24/7. So appreciate you having me on.
Yes, you can. You're right up there with the other oil and natural gas experts I've interviewed. So thank you again for your time. I appreciate it, and I enjoyed the discussion today.
Yeah, cheers.